What is interesting, actually, these three presentations, my observation was yesterday we had macroprudential policy, monetary policy, but today we brought also here fiscal policy, because in all three presentations, taxes were mentioned. And my understanding was that both of you you assume at least that tax policy could be quite effective and helpful. At the same time, your view was that the tax policy might take too long, and macroprudential policy can react faster than fiscal policy at the same time. So after all three presentations, I would like first to the panelists to react to each other's presentations, in case you want to say something about what has been said. Please, Dirk.
Thank you. I like the question Richard raised was about political sensitive. When macroprudential policy, but interest rates are equally politically sensitive. I remember a few years ago when interest rates really went down and QE started. My father, who is not an economist, but lived from his pension, and his pension is just his savings. And then he said, are they getting crazy? Because I don't earn anything anymore on my savings. So arguing that monetary policy is not politically sensitive, just because we have been doing it for a long time, we are insensitive to the arguments. But it is really redistributing, no question about it. And there is now a huge debate on QE on this issue. So, and of course, telling a young couple they cannot buy a house is extremely difficult. But if you tell them they cannot buy a new house now, and maybe 2 years later when the house price goes down, they don't have negative equity, they may be happy that you did it. So there are more elements to it. When I was in the early 90s in the UK, every 2 houses you saw one sign in the street for sale. And I remember huge negative equity was the new word. And in the Netherlands, out of 8 million households, about 1 million had negative equity. So not doing any consumptions, no holidays, no new cars, just stay and sit still. So there are 2 sides to the coin. Saying no to a mortgage may also help sometimes people for what happens later on.
Okay. Thank you. Would you like to say something?
Yeah, so 2 quick points. So, I mean, I agree. It's self-evident in Europe that monetary policy, the conduct today is sensitive. But I think it helps Mario Draghi a lot that he can say, at the end of the day, I have a clear target, inflation below but close to 2. You can all monitor inflation every month. You can see where it currently is. And I have a mountain of papers I can quote to explain why I'm doing what I'm doing. I think if you go back to 2006 or 2005 and put a macroprudential policymaker in that position, knowing the future, but how would he explain, or how would he or she explain the future? How would he or she show a measure of systemic risk that's being published on a monthly basis by statisticians? Where's the body of theory that would say the developments we see today in 2005, they're going to lead to catastrophe in 2008? I think that again, there is a difference here. The other point I think I would say briefly is I think I can tell you a system that's going to do very well for resilience. It's very well capitalized. But I think it will look, and it could behave very much like banks used to in the 1950s and 60s. But I think there'll be a fraction of the population that will almost be structurally locked out of credit markets. So for that fraction of the population, I think we know that's very bad for their welfare. They won't be able to smooth consumption. And I think economics may not tell many things convincingly, but I think we're pretty clear it's bad for them. And what I want to know is, how do I weigh up those things? We all talk about resilience. The system I described will do very well on that score, but it will leave a few people behind. So that's the difference. So monetary policy, yeah, the swings and the roundabouts. At times when wage inflation is too strong, you might have to raise interest rates, and unfortunately unemployment may rise. I'm talking about people being locked out of credit markets on perhaps their whole working life, at the bottom. I think that's a major policy issue. And we might say, back to the presentations of yesterday, it's a big social problem. Leave it for the fiscal authority.
Can I just make a suggestion on that? Like in the UK, you had this equity for households. in the Netherlands we have a huge discussion, use your pension fund as equity down payment. Because I think if you look at John's presentation, it was quite clear. The credit-driven house price booms are more dangerous than the non-credit-driven. So if we make equity available to households, either, for example, in the Netherlands during the crisis, still now, you can transfer money without tax to your children, but that's of course only for a part of the population. But if you make pension fund contributions available and that kind of thing, so we help out on creating equity, so then we have a lower loan to value, but then, and at the same time, we try to help out creating the equity for young households, so we don't stop them in buying houses. That could be helpful.
At the same time, more of your equity would be tied in the housing market if you use your pension to. I have one more question, actually. What is interesting, Richard brought another dimension a bit. So you mentioned that this aggregate demand issue you brought to the table. So in a way, the debate so that protect the economy from the financial system and from the housing market. Because the housing market, it is construction activity is dependent on that, and housing is an important part of wealth for many households. So there are this consumption smoothing argument, and at the same time it was missing in John's presentation. John's focus was very much on resilience. And I was wondering what you could say about that, whether there's sort of a bigger... Ultimately, all the policies should aim at stabilizing GDP or even getting GDP growth. So this argument demand point, I think, is very valid. And all policies, fiscal, macroprudential, monetary, the ultimate target actually goal is to increase GDP growth. John, what would you like to say on that?
I had noticed that in Richard's slides, the reference to the chart from Floden, where households that are more heavily indebted reduce consumption more strongly during the crisis. I haven't written about this myself, but Paul Tucker has, and Paul Tucker's answer to your question is that that's not a macroprudential policy objective. And again, it fits into this Tinbergen principle. We need to be clear about what the objectives are and what policy instruments we have for influencing those objectives. So Paul Tucker has argued that to deal with this expenditure concern, you should deal with it with taxation rather than with macroprudential policy. So, of course, the activation of any policy instrument is going to have an influence on the objectives that other policymakers are seeking to attain. But that will require a policy response on the side of the policymaker that is suffering the spillover rather than the macroprudential policymaker, I would contend.
Okay. Thank you. Any other reflections? Please.
Can I raise the fiscal issue? I worked for 10 years at the Ministry of Finance, and we had once a major overhaul of the fiscal system. And we all know that transition in fiscal system is more difficult than designing the optimal system. So when you do the transition, you always need to offset the losers. So you do a huge handout during a transition in fiscal rules. And if you prepare that, there's a huge administrative exercise. You need the parliamentary approval. You need to get the systems ready. So it is impossible to time. So once you do it, you have a timetable. And then it was implemented at the time when just the economy was already growing very fast. And then you're a policymaker, and then you either face the decision, no, we stop it, because then it is really out of the window, or we go ahead. Well, we went ahead, and the economic boom went further down the road. And that's the lesson from fiscal policy. There are huge time lags. You need parliamentary approval, because that's why we have a democracy on fiscal issues. So, although in theory you could quickly, overnight, change property taxes and that's so on, the reality is that it takes far more time, and that's why we have a technocrat central bank to move overnight interest rates and potentially overnight LTVs. So when I heard this morning about this counter-cyclical capital buffer, that it takes 9 months to implement, and I'm getting extremely worried what the effectiveness of that is, so that like this fiscal thing can become pro-cyclical. So we really have to, if we want to be counter-cyclical, in addition to resilience, we need to check the policy lag, and if it is too long, then it is not a good instrument.
Just to confirm your point, I think in Hong Kong, when they make changes, new LTV is effective immediately tomorrow, as of tomorrow. You want to?
I was just going to reply to what John said. I don't want to give the impression that we're disagreeing. I think we're probably more or less the same page. We maybe shouldn't get hung up on what things are called, micro, macro, fiscal. We should understand the system, identify the problems, figure out what the right instruments are to deal with those, based exactly on the analysis you provided. And it may turn out the fiscal authority has some, and the macroprudential authority has others, and then off we go. I was just trying to list the kind of the problems that may sit there within this kind of interplay between credit, housing markets, real economy. I actually agree with Paul Tucker. Again, if the force of my argument is don't maybe try and run before you've learned how to walk. And I think that's Paul Tucker's point. He may be, I don't speak for him, but he may be okay 50 years from now making that part of the remit. I think he thinks we should start by focusing on resilience, but then being clear about that and saying what he would say a central bank is not responsible for and what it is.
Okay, thank you. I think we need to open the floor for questions from audience. And I saw John was first to raise a hand. Please.
So I have a quick question, one for Dirk and one for the rest of the panel. So Dirk, you mentioned the internet bubble and it was not structural. Now, many of the most valuable companies of today were created and financed in the internet bubble, including Google and Amazon and others. So is it possible, and if you look at the history of bubbles in the past, the bubble of the 1973 created the semiconductor companies, the bubble of the 1920s created GE and many of the other companies that are now dominant in manufacturing. So is it possible the internet bubble was much more structural than you implied? And the question for the rest of the panel is that if you take Amazon.com, Amazon.com was created by the parents of Jeff Bezos remortgaging their house at the height of a housing bubble in the early 1990s. That was the start of financing. So if the US financial authorities had decided to implement counter-cyclical macroprudential policies to reduce rising real estate prices, Amazon might not have been created. So is it possible that, is it the view of the panel that rising housing prices are only negative, or can they also provide a useful social function in financing the new companies of the future?
Who wants to start? Please, take.
There are two narratives. I like your narrative, John. Can I have a different narrative? Let's say when you travel back home to Iceland and you stop halfway in Ireland, and you're one of these guys who were buying a second apartment for investment reasons to earn money, and then you were caught by the bust of the Irish housing boom. Would you not have thought, well, there is the Central Bank of Ireland, if they would have been more proactive, I would not have made these losses, and they may lose out 5-10 years of their lifetime in problems. So we have the rich people, and they may have benefited. So there are two kinds of narratives. So we have to watch all the people, not only at the success stories. And on top of it, I'm not sure whether just moderating the new economy, not stopping it, because I think that's why I don't like the title targeting house prices. No, we are not targeting house prices. We are slowing down bubbles, nothing more. So Kinderberg or Minsky, slowing down bubbles to take the excess out and not taking everything away, because then the damage afterwards is slightly less. So we are only slowing down. I'm not sure whether it would have stopped all internet companies coming to the forefront. Maybe some would have been lost, yes, but I'm not sure whether all the companies would not have emerged. So I think that's an open question. But you raise a good point that we should look at both sides. And thanks for reminding.
Please.
Do you want me to go first?
I thought that was a great question, and it's often that argument is often made that bubbles are not purely costly. That there are plenty of examples like the ones that were just cited that you can have also benefits of bubbles, that parts of the economy that have become very productive new technologies and so on are financed with even cheaper finance that would have been available if you didn't have a bubble. But on the other hand, I mean, the question is, okay, you've got a housing market bubble going on, and banks, and maybe banks have got caught up in the euphoria of the bubble and are lending into the housing market. The question is, what the counterfactual? What is happening to the rest of the economy then? There are other parts of the economy. If banks are just lending to the household sector because there's a boom going on, other parts of the economy are not getting credit because the banks are focused on the housing market. So, of course, it's difficult to measure that. What is the counterfactual? But I think economists, I think it's not a controversial statement to say that we worry about the misallocation of resources, and this is one of the big costs of booms, and that there of asset price bubbles, that parts of the economy are starved of finance.
Yeah, I mean, absolutely. That's one point I wanted to make. I mean, it's very easy to tell the stories you did, but you can't tell me the story of the person who would have invented, I don't know, the jetpack in 2001 or 2009, but couldn't because credit conditions had tightened. So we only see the success stories along a narrative, which is obviously a history of financial crisis. To your general point, yeah, of course, I mean, it's entirely consistent with what I said about worrying about structurally tightening credit conditions for those on low incomes. We know that rising house prices ease credit conditions. And at a micro level, that's, so long as house prices keep rising, that's a very good thing. It gives you security that you can smooth consumption in the future. More broadly, I think your question gets to the fundamental question, I think, in all of this, which is there a trade-off between resilience and growth? And some people basically think there isn't, in which case my answer is always, well, why don't we just take capital ratios to 90% and be done, and the system will be safe? Usually people say, don't do that because there will be a trade-off, it'll hit growth. And we don't mean demand, we mean supply. That in the end, credit will become more expensive to your stylized SME in the real economy, and you're going to slow the pace of innovation. So I think everyone who's thought about Macroprudential worries about that question. I think the single most important research question is to try and figure out the slope of that trade-off.
Thank you. I think, okay, Tariq, please.
Yeah, I have a question about the wording to all the panelists. When we talk about targeting real estate prices, that's one thing to say. This is a key indicator for as a build-up of systemic risk, and we should monitor them, obviously, etc. And I think we all agree on this. Another thing is to get to the temptation of setting an explicit numerical target of real estate prices for Macropru. And on this, I would be very cautious, because otherwise, as it was said previously, we run the risk of setting something unachievable for Macropru, or we will be judged on something that we don't even have empirical evidence that we can have an influence. And if it's an influence, isn't it just a side effect influence rather than targeting? So I would be more cautious. So I would have to I guess I already know your view on this, but I would like to hear it again.
Indeed, that's a very valid point. At least at this stage, we're not there yet, as Richard highlighted. And I think what you said, that your suggestion was at least to try to dampen the housing cycles. This is what Hong Kong is doing, I think. So exactly so. And at the same time, I would like you're going to say something, but my question would be to John and to Richard. Would you at least agree that dampening housing cycle, there is some merit sort of in that? Okay, maybe with Dirk, you first.
I think we heard this morning a very nice answer to that, because I think when Stephen was quoting Charles Coulthard, so you make these presumptive indicators, and then you make a range, because we really need a range, and we cannot say 2 or 3%, but you make a range. If you're outside that range, or above that range, then the macroprudential supervisor has an inclination to act, and then with comply or explain, then either you comply in your act, but if you don't act, you have to explain why you're not doing it. So that's good for accountability, and we all know that many people are risk-averse, and we know that central bankers are at the outer end of the risk-averse spectrum. So explaining that you're not acting, they don't do that quickly. So this presumption, if you're outside or above this range, then you should act like Denmark and Norway are doing, or you should, we don't need this letter to Parliament like on the inflation target, but what you could do is that you have to explain in the financial stability review why you are not or not yet acting and what the reason is. And that takes away the inaction bias, because I think that's the main worry, the inaction bias. And by having and then you really need a broad range. So I fully agree on it. And I think that's the main point Richard is saying. We are not able, not at all, to have precise numbers, but then you can work with threshold. And we don't need magic. I mean, if prices are rising 15 or 20%, come on. We don't need magic that we know something is going on. So in that sense, we have always a feeling if something is going on or not.
Okay, thank you. Please.
I mean, this is coming back to the question of the whole that this panel was asked to answer at the beginning. I mean, I want to come back to the question of what is the objective then, really, of stabilizing house prices. I think there could be, of course, a case for tightening macroprudential policy if all the models are telling that that the house price exuberance is not justified by the fundamentals. But nevertheless, I don't think that the objective then should be to target an explicit level of the house price. And actually, partly because I don't think it's possible to do it, but also because I'm not fully clear on what the objective is. For me, the objective has to be containing the risks that the financial system is confronted with, and if the financial system itself is not itself exposed to the property market, then we may not worry at all about it. But it's an issue for another policy domain, a housing policy domain, or a tax
GDP growth.
Right, but that's not the objective of macroprudential policy. Macroprudential policy is not about smoothing. We had a presentation yesterday which suggested that there is coincidence between the business and the financial cycle, but I think the way that the thinking has been evolving is that there is a distinct financial cycle from the business cycle, and that is what macroprudential policy is aiming at moderating, not the business cycle. They're different.
Yeah, so I mean, again, hopefully it was clear. I would very much echo, I'm not at different points in time along how far we get up the learning curve. We may take different judgments about answering that question. It may be at the moment we just go after resilience. 20 years from now, maybe we say even when resilience is secure, we try and stabilize that cycle, but we don't know how to do it. So I'm usually accused of just only being negative, so I thought I would try and answer this question and be constructive. So what would I do? Yeah, I would look at these presumptive indicators, but I think again, we or central banks have to really mean it. So when house prices are rising really fast, we worry because we think the correction is going to be more severe. So I think in the end that means, well, central banks have to be clear about that, which means more aggressive stress tests. Every time house prices go up, if we think the future could be worse, let's show people. Let's publish forecasts. Now, they're not central case forecasts like we're used to on growth and inflation, but every 6 months say, well, now we think the downside, the 5% tail now, could be a 20% correction down in house prices. And we think this many people will be thrown out of, lose their homes, and unemployment could rise by X. If we really mean it, if we really think it, and I think we do, that house prices are this latent threat, as you said, 11 out of 10 of the last crisis. So partly it's looking at presumptive indicators, partly it's about responding, but I think trying to get people towards the thing we ultimately care about, it's going to be important to explain how we get from a period where everything feels good, house prices are rising fast, reminding people, showing people. And that's going to be uncomfortable because our forecasts of those bad outcomes are going to be very imprecise and could look wrong for 5 years. But if we believe it, if we want to lean against it, I think it's incumbent upon central banks to do that work.
Can I raise one issue? Is really, in the end, is the aim of the macroprudential policy protecting the financial system against problems? And I think we should look wider, because the financial system in itself can never be an aim, because the financial system is supporting the real economy. And I think yesterday Gerhard showed that the borrower characteristics are quite important. And that's why I think there is a clear consensus. So there's many fields there is no consensus, but on one element there is consensus that the most effective macroprudential tools are borrower-based. So LTV, LTI, and so on. So we don't do that only to protect the financial system, I think, and that should not also be our only worry, because we really want the ineffectiveness, the misallocation of these housing bubbles, and in the end housing is a financial asset also, to take away. So even if the financial system is not a danger, there could still be a case to lower LTVs if housing prices are rising too fast. And take Hong Kong, they have LTVs of 60 or 70%, so you can have 30-40% loss before the banks are bankrupt, so there is no problem for the financial system, but you do the LTV to slow down the housing market, because the housing market is misallocating the economy. So I would really argue, but that's the point of difference, and I'm also interested what people think about it, whether it's only about the financial system or really you want to have this important asset market, you don't want to distort the economy too much. So then you go back to the ultimate aim of policy is always the real economy, and financial sector is only an intermediate point.
So maybe just a clarification. I agree with everything that you said, Dirk, but I think it's about what I have in mind is the horizon. So is the question about moderating the business cycle or the long-run productivity of the economy? I think the horizon, of course, why do we care about financial stability at all? We care about financial stability because we care about the capacity of the financial system to support what's real economic activity. But I don't think that the Macroprudential Authority should be given an objective to smooth the business cycle when there are other policy domains that are doing that. The preservation of financial stability is really aimed against avoiding the kind of thing that we saw in 2007, 2008, where you have a long-term destruction of productivity and big, really economic costs.
I'll try to be provocative. Is that a question of cooperation?
It's not a business cycle. What?
It's a question of cooperation. If they cooperate, if they were to cooperate more, these policies, they could, maybe. To put that another way, sort of. You would like to add something? Or
well, I was just going to say, just briefly, so 2 points. I mean, I think if you ask finance ministers, their biggest single concern actually is around most of the advanced economies is why productivity growth is so slow. And our suspicion might be the financial sector ought to have, or the structure and configuration, both structure and through the cycle, might have something to say about that. But then it's back to this, again, point of, well, whose responsibility would it be to deal with that if there's a cyclical and structural problem? So again, I think it's identifying an underlying problem and then figuring out what's the best instrument and then who's the best person to wield that instrument and then all the configuration questions. But I think it comes back to the fundamental question, what's the model, what's the problem, before we argue about what lever.
Yeah.
Okay. So our time is up, but nevertheless I would still offer opportunity to ask questions from the audience. Any more questions? Okay. Thank you. Time for a break. Thank you for panelists. That was interesting discussion. Good presentations indeed. And we get back after 20 minutes.